Hello everyone, I'm Shekhar from Momentum Lab. Now in today's video, I'm going to do a deep dive on factor investing. Now this video is different from the previous videos in one sense. Now we have 20 years of data from NSE. Since inception, that is 2005 April 1 onwards, till 2024 August 22nd. We have 20 years of data. Now based on these 20 years of data, we have done a lot of analysis and churned out some great insights. Now, this will be a comprehensive video which will lay rest to all the comparisons between which index is better and which is not performing, which is performing. So we wanted to make one single video which will cover or answer all these questions. So there have been a lot of queries or comments from our viewers asking to compare one index with the other index. Now, if you go on comparing one index with the other index, then there will be a lot more to be covered. So we wanted to avoid that, and we wanted to do in one single format. So everyone can get this video or get the understanding in one single video rather than watching multiple videos. So that's the whole point and essence. So let's quickly take a look at what I'm going to cover in this video. First, I'll explain what are the different factors in India which are available. In general, I'll also talk about what is factor investing if someone is new to this style of investing. And secondly, I'll show where do you get this 20 years of data from NSE website. And we'll also do a comparison of these factor indices with Nifty 50. And later, we'll also compare amongst themselves, amongst all the factor indices which are available, we'll do a comparison. And lastly, what we're going to do is we'll summarize every month a report called as monthly factor performance report. Now, in this report, what we're going to do is we'll give you the best mutual funds or ETFs which are available, offering these factor indices, top factor indices. We'll only pick top 5 or 7 factor indices. We'll not go beyond that because NSE has been kept on churning many strategy indices. Right now, the list is at 20. And looking at their pace, they may in fact go even further. So we want to break this down and pick the only top ones which are extremely good, and it makes sense for investors to DIY investors to go ahead and invest in them. And then we'll also compare how are the different factors performing over the last 12 months. So just to give you a glimpse how it might look like. So it might look like this. So we'll have value, volatility, momentum, and quality, and we'll see every month which index performed well and which index did not perform well. So the index which performed well will get a rank of 1, and the one which didn't perform will get a least rank of 5. So this way we'll see how is the shift or transition happening between different factors. So I'll explain factor investing with a simple example, and then we'll move on to the next slide. So let's assume you're given a task to find out the reasons for success for some of the students who are cracking exams like IIT, UPSC, CAT, or GRE. And you go ahead and talk to them and get some of the reasons. Some students say that it is because of their study time that they're able to be successful. Some people say it is because of the study material. Some others say it is because of their consistency, that they've been doing really well in their college, school, undergrad, and then they were able to easily crack the competitive exams also. So you can see that there is a unique factor or a unique attribute which they say is a contributor to their success. Now, we do not know exactly which factor or attribute is contributing to their overall success, but these are some of the factors. Now, same way in stock market as well, for a stock to overperform or to perform better than the index, there are certain characteristics or attributes it must possess. There have been already certain list of attributes and factors identified, and we'll be delving more deeper into them. Now, the list of factors can go up to 300. And it has now become a factor zoo. On a daily basis, some of the other factors are being researched and being proven. But we only take into those factors which are reliable, robust, and have been time tested or also spread across geographies and shown to be statistically significant across different time frames. Now we'll consider only these factors. There are 6 different types of factors, in fact, 5 different, but the 6th one is the multi-factor, which is basically a combination of all these or some of these 5 factors. The 5 factors which are provided by the NSE or BSE are momentum, value, low volatility, quality, and alpha. So these 5 and the 6th version is the multi-factor, which is a combination of all these 5. So this is the universe that we have. Again, this universe can expand based on the market cap. Let's say if someone wants to, or if someone wants to create a momentum index based on the top 500 stocks, then there's a separate uh, index for it. If someone wants to create a momentum portfolio based on the top 200 stocks, there's a separate index for it. So there are a lot of different combinations that you can see. As of now, as on today's recording, there are 20 different strategy indices provided by NSE and four different strategy indices provided by the BSE. So we'll compare among these 2024. So let's take a look at the place where you can get all this data. So this is the link where you can download the historical data of all the different indices. I'll be sharing this link anyhow in the YouTube description. So you can select the total return index. We'll be needing a total return index because we'll have to take into consideration their dividends, splits, bonuses, etc. So that it is helpful to take TRI instead of just closing prices. We'll select the index as equity, and then we'll select the index of our choice. Like let's say I want to see Nifty small cap to 50 momentum quality 100, and then select the time frame from 1st of August till 2004 August 2021. You can choose whatever date you want, and you can download the data. Now, once you download this data, what I've done is I've taken for all the different types of indices. You can see in this sheet that the data is available for all the 20 different types of strategy indices. Also, I've also taken Nifty 50 to do the comparison since August 1st, 2005 till 20th August 2024. So these are the different types of indices that we have. I've taken total 18 into consideration for the comparison purpose. I've left two. The ones that I've left are Nifty quality and the other one is Nifty value. The reason for this is that we have data only from 2009 onwards in the NSE website, and hence to maintain the parity or comparison to have 20 years data, right? I've omitted these two and we'll compare with the 18. Now, among these 18, I'll show the nomenclature so that it is easy to understand what I'm referring to. So, any index, I first mentioned the universe from which it takes the stocks. So, let's say Nifty mid 150 means that it is taking stocks from Nifty mid cap 150 underscore M50. M here means momentum, and 50 is the number of stocks which has in its index. So, M means momentum, V means value, L means low volatility, Q means quality, A means alpha. So if any index has more than one factor, then we will have all of these. For example, in multi-factor, let's take this one. Nifty mid-small 400, meaning the universe is mid-small cap 400, underscore MQ 100, meaning momentum, quality 100. So it takes into consideration both the factors, momentum, quality, and ranks out the top 100 and invests in them. So these are the different list of strategies that we have. Now, before I proceed, first what I'll do is I'll do the basic data analysis for Nifty 50 so that we have the benchmark ready, and then we'll compare for remaining strategies. So for Nifty 50, what I've done is we have these three data that we have from the NSE. That is, we have the date and the total return index for every end of the day. Now, from that, the next step that I calculate is the daily percentage change. And from daily percentage change, and then what I do is I bring it down to NAV format so that I have like-to-like comparison when I do with respect to each index and with respect to Nifty. So once I do the NAV format, the starting point is 100, and we'll see where does each strategy end. So higher the final NAV value, it tells higher is the CAGR for that particular strategy. Now, once I have NAV, what I did was I calculated the maximum drawdown using these two formulas. You must have already been aware. If you haven't, you can check my previous videos. I've shown how to calculate the maximum drawdown. Now, once I get the maximum drawdown, then the next two fields that I'm going to calculate or derived metrics that I'm going to calculate are 3-year rolling return and 5-year rolling return. The problem with point-to-point CAGR is that it has its bias of leaving what has happened throughout this entire journey. It doesn't take into consideration the ups and downs, the volatility, the peaks and troughs throughout its journey. It just takes the starting point and end point and calculates the CAGR. That's why I don't prefer point-to-point CAGR comparison for any strategy. Instead, I look at 3-year rolling return or 5-year rolling return. Now, to get 3-year rolling returns, what I'll do is I'll take with the time difference of 3 years and calculate the returns that Nifty 50 has given for this 3-year period. And it starts from 31st July 2008 onwards. So in total, we have close to 3,974 data points or 3,974 records of 3-year rolling returns. Now, same way I do for 5-year rolling returns also, just to show uh, the performance of the 5-year period. And for 5-year, we have close to 3,485 number of records which have 5-year rolling returns. So let's quickly plot the 3-year rolling returns to see how does Nifty 50 fare in general for the last 20 years. So we see that there are very few instances where Nifty 50 was below 0%. And we see that there are some instances where over a 3-year period of time, Nifty 50 did give returns above 20%. There are few instances at 30% also, but yeah, it did give a couple of times above 20% and a couple of times below 0%, but mostly it lied within this range. Let's see what is the average range in which Nifty 50 lied for these 20 years, taking the 3-year rolling return as the consideration. So let's just bring these values down, bring this chart down. So what I've done was I've taken the 50 percentile level at which you see the 3-year rolling returns lying. So to do that, what we need to do is we need to use this function called as percentile. And when you select the data range and give the input as 0.5, it will give you the 50th percentile level, meaning the 50th or the median level in which all these data points lie around. So you see that the 50th line or percentile returns are at 12.35. So on an average, you can expect that Nifty 50 to give rolling returns of 3 years for 3-year period to be around 12.5%, somewhere in this line. Now, if you consider yourself to be lucky and you, let's say, fall in the top 25% of the returns distribution, then you can also do one more thing called as you can see the percentile. You can change the percentile to 0.75 and see what is the percentage returns that you can expect. And for top 20, top 70, top 25 percentile, this number is 16.24%. So this is somewhere around these levels, 16.24%. If you consider yourself to be not that lucky, and let's say you are below moderate, and you consider yourself to be unlucky, and you expect returns which are in the bottom 25 percentile range, then these are the returns that you can expect from Nifty 50 for a holding period of 3 years. That is 7.45%, almost equivalent to the FD rate. So with this, we'll get a very good understanding of how the returns are distributed by Nifty 50 over 3-year period. You can also look at it in a different way. You can actually do a histogram of these returns, and you can see that this histogram follows a normal distribution where majority of the returns lie centered around this line, this level around 12 to 13%. So that's what we have seen in here also. And the range is quite big. Like some unlucky few might get negative 10% returns even after they held it for 3 years. Maybe they've exactly entered at the top, and hence after the 3 years also they weren't able to make any money. They got minus 10% returns, and then there could be some lucky few, like I mentioned, they might have got 35% returns over the 3-year period. Maybe they have timed it really well. They've purchased at the bottoms, and they could get pretty handsome returns. But majority of the people or folks would lie somewhere centered around here. That is at the 50th percentile. Now, just to give a sense of how will this look like if the average rolling period instead of 3 years, if it's increased to 5 years. Let's take a look at that. So I've done the same analysis for 5-year rolling returns to see what does the topmost percentage return look like, and the bottommost percentage, and the median percentage, and the top 25% and bottom 25% look like. So you can see that the range has now shrinked. The bottommost range has shrinked, as well as the topmost range also has shrinked. And the data now mostly centers around 12.5%. You can see that the median level still stays around the same level, 12.5%. But the bottom 25% increases a bit. that you, let's say, even if though you are unlucky and still wait for 5 years in Nifty 50, you end up getting a decent 8.5%, 8.76 or 8.5% returns. And if you consider yourself to be extremely lucky, and if you feel that you can fall in the top 25 percentile, then you can expect in the returns around 14.65%. Now, we can also see that as a box plot to just give you a sense. As the time increases, there's a box plot. There's the minimum value that we see for a 3-year rolling return, and there's a maximum value. And 50% of the results would lie in this box. There's the bottom 25 percentile, there's the top 25 percentile, and there's a 50 percentile range. Now, for 5-year average rolling return period, you see that the range shrinks. Even the 50 percentile or the mid 50 percentile box, this also shrinks. If there's a shrinkage in the returns, it means that there is more predictability, more certainty in the returns that we can expect. So that is with respect to Nifty 50. Now we have the box plot, which basically gives the top 25 percentile range, bottom 25 percentile returns range, and the median 50 percentile returns. We also calculate the maximum drawdown and the volatility across the 20-year period. We also calculate the CAGR since inception, basically the final value divided by the final initial value. And we also get the average rolling return across this period. Now, the average rolling return roughly will be aligned with the 50 percentile returns that we saw here, tier rolling returns. So this is the set of analysis that we did for Nifty 50. Now let's see the same set of analysis for a strategy index. Let me pick mid small cap 400, momentum quality 100. Now in here, I've done two additional things. One, apart from plotting the 3-year rolling returns, which is marked in blue color, I've also plotted the 3-year rolling returns of Nifty 50 so that it becomes easy to compare. So you see a blue colored line being the strategy and the red colored line being the index, being the Nifty 50 index. So from now on, when I say index is nothing but Nifty 50. Strategy is nothing but the factor index. So the strategy is shown in the blue color, the Nifty 50 is shown in the red color. This visual representation helps understand how often did the strategy beat the index, and by what quantum did the strategy beat the index. Now, to see the excess returns or the alpha that the strategy had over the Nifty 50 index, I've plotted this differential. So if the differential is in a big blue colored line, it means there is massive outperformance by the strategy over and above the Nifty 50 index. If it is a negative territory, it means that the strategy is underperforming the Nifty 50 index. Now, you can see from this chart that majority or most of the times, the strategy is outperforming the Nifty 50 index. Let's also quantify that. So we can see that there are total 3974 observations. Within this 3974 observations, 3,350 times this strategy, mid small cap momentum quality 100, has overperformed or did better than the Nifty 50 index. And that translates to 84% of the times, whereas 16% of the times it has underperformed. Now, this difference between the Nifty and the strategy and the Nifty, if the strategy is better than the Nifty 3-year rolling returns, it is in positive value. If it is less, it is in negative value. And this difference, we call it as alpha or excess returns over and above the benchmark index. Now, what we'll do is we'll plot the distribution of this alpha so that we'll see where does this or how does this alpha reside on an average. You see that this excess returns or alpha also follows a normal distribution. And in the normal distribution, what we do is similar like how we did in the Nifty 50 case, where we identified the top 25 percentile returns, top 50 percentile returns, and bottom 25 percentile returns, right? Same way, now what we're going to do is instead of returns, we're going to calculate the top 25 percentile alpha that this index, mid small cap 400 momentum quality 100, generates over and above Nifty 50 for a 3-year holding period. That's a mouthful to say. In a nutshell, what we are trying to essentially do is to see what is the alpha that this index generates over a longer term. Now, for us, the longer term is here 3 years. So we see that the median value or the median value of the alpha or excess returns lies at 7.56%, meaning if you invest in this index momentum quality 100 for mid small cap 400, and you consider yourself to be a normal or average investor who doesn't know how to time the market, and you enter randomly, and if you have stayed with this index for at least 3 years for the last 20 years, then on an average you would have generated returns at least 7.5% returns over and above the 12.35% returns that were seen in Nifty 50. So this translates to roughly around 20% CAGR for a period of 3 years. Now we see what is the bottom 25 percentile alpha. That is at 2.21%, and the top 25 percentile alpha, which is 13.38%. So we are interested in two things. One, we want to see the count of outperformance of the strategy with respect to index. That is one. Second, we also want to see the quantum of outperformance. If the strategy is outperforming the index, but if the quantum is very less, let's say it is only outperforming by 0.01%, then it might not translate truly into the returns that we get. We are interested in the longevity of the outperformance and also the quantum of the outperformance for us to take into consideration. So the first metric that is really important for us to acknowledge is the percentage outperformance or overperformance days. So this number, higher the number, better it is for us. Second is we'll also want to see the quantum. Now for quantum, we have three different matrices: top 25 percentile, top 50 percentile, and bottom 25 percentile. I am really interested in the bottom 25 percentile because I don't even consider to be lucky, and I also don't even consider to be a normal. I consider myself to be unlucky. So let's start with the worst case. If assume that I haven't timed the market properly, I have entered at a very wrong time. Assuming the worst case scenario, still, if I'm able to generate alpha, being the bottom 25 percentile investor, if I see that there's an alpha over and above Nifty 50 index for me, then that is a good strategy. So let's take this in our consideration set. So two metrics that I consider: one, the overperformance percentage or the longevity, and second, in the overperformance that is there during this time, if the unlucky person also, if they can make money, then that's a strategy that I like. This and this. Now let's take the other metrics also, which I feel are important. One, we'll take the maximum drawdown. Let's highlight this also. And then we'll also take the volatility into consideration. Higher the volatility, it is bad for us. Lesser volatility is good for us because for a retail investor, we can't fathom such huge swings. And we'll also take into consideration the average rolling returns, 3-year rolling returns, so that we'll know what is the rough number that we're going to get. Now we have seen that these as the important inputs. We have done the same analysis for all the different momentum, or sorry, all the different strategies, not just momentum. Now in the summary table, I have listed down all the strategies, and I've also mentioned all the matrices that I felt which are important to be tracked. Now, out of these matrices, some of them may be important, some of them may not be important. Some of them may be even more important and they should have a higher weightage. Some of them might have a lesser weightage. So that is all subjective, but I'll show my thought process and how I went about doing this analysis. So the simple or very naive analysis that usually people do is just to compare the CAGR since inception and calculate the returns and then see which one is doing well. So we have put that metric here, CAGR since inception, but I'm not going to use this in my analysis. So I'm going to hide it for now. The second metric, which is helpful, which is one level deeper than this CAGR since inception, is the 3-year rolling return. This gives a better picture, or it is more believable, or this has some merit into it, because if someone is investing for at least a period of 3 years, what is the average returns that they can expect. That we can only get to know with the help of 3-year rolling return, like I've shown in the charts, right? This follows a distribution, and we'll see the average value of these 3-year rolling returns and get these numbers. So this is one such number to pay attention to, and this we'll be using in our analysis. The second metric that we will be using in our analysis is the percentage outperformance days. So the percentage outperformance, higher the number, better for us. It means this particular strategy has performed better than the Nifty 50 index. And if the number is less, it means that it has performed less. So there are, again, extreme or variations to it. There are some strategies which have done really well, which have performed more than 85% of the times. And then there are certain strategies which have done pretty less, like 50% of the times they have performed well, 50% of the times they haven't performed well. So I've given in the color coding, you can see the green ones are the ones which have higher outperformance days. And the next three matrices are nothing but the versions or variations of the box plot, the top 25 percentile, top 50 percentile, and bottom 25 percentile. And please note that I'm here calculating the alpha. So this has to be actually needs to be here. Now, like I mentioned, outperformance gives the count, but the alpha will give us the quantum. So to get a sense of what is the alpha of this strategy over and above the index, we're going to plot the top 25 percentile, top 50 percentile, and bottom 25 percentile alpha for each of these strategies. Now, among all these three, I said I will be interested in bottom 25, right? So I'm going to hide these two, top 25 and top 50 percentile. Then we are left with maximum drawdown, volatility, and Sharpe ratio. So among max drawdown and volatility, I'm going to pick max drawdown and omit volatility, because volatility is already part of Sharpe ratio, because we're going to consider Sharpe ratio as one of the important metric. Sharpe ratio is nothing but the returns divided by the volatility. And hence this is a derived metric of both CAGR returns and volatility. I felt this alone will summarize both volatility as well as CAGR return since inception. So these are the 5 final matrices which I felt are important to identify or determine any particular strategy. So I've given a higher weightage to percentage outperformance and the bottom 25 percentile alpha returns and 3-year rolling returns, and equal weightage to max drawdown and Sharpe ratio. So that's how this ranking is done. You can see that the weightages are represented by like this number, like 0.2, 0.2, 0.4. 0.4 is for the bottom 25 percentile alpha, and outperformance F has a weightage of 20%, and the 3-year rolling return has a weightage of 20%, and the remaining two, maximum drawdown and Sharpe ratio, has a weightage of 0.1 and 0.1, meaning 10 and 10%. So this I gave 40%, these two I gave 20% each, and these two I gave 10% each. Now you have all the raw ingredients. These 9 are the raw ingredients that you need to take into consideration for identifying which strategy is better. The weights can vary based on one's own preferences. This is based on my preferences. I have used this. I'll share this summary sheet. You can play around with the numbers of your choice according to your weightage and derive at the final score. Now, once I've calculated these scores, this is how the scores look like, and this is the final rank basis this score. Now let's take a look at the data ones, what is coming out and what is not. So you see that majority of the momentum strategies, they come up in the top. And the multi-factors are also there. Multi-factors, in fact, the mid small cap 400 multi momentum quality 100 is the first strategy which does well on all parameters. After that, momentum, and then after that we have Nifty small cap 250 momentum quality 100, and then we have Nifty alpha quality value low volatility 30 as the 6th position, and in 7th we have Nifty mid cap 150 quality 50. Value is down. In all parameters it has not done that great in the last 20 years in the Indian context. Maybe I think it has a different connotation, different markets, I believe. But yeah, value hasn't performed that well in the Indian market. I'll do a deep dive on each of these sectors separately, or each of these strategies like value, alpha, quality, low vol, multi-factor, momentum. But the main takeaway from all the strategy indices which are available in the Indian market is that momentum and multi-factors that also which include momentum do well. The reason that I believe to understand is that momentum is like a chameleon. It morphs into a style which is doing well at that point of time. If value is doing well any given certain time frame or time period, then momentum becomes value. If quality is doing well, then momentum becomes quality during that time. So because of this fluidic nature of momentum, to pick the ones which are doing well and stick with it, momentum performs over a longer period of time. That's the key takeaway that I had. But still, people might have a few more questions like, why is alpha not featuring on top if it is similar to momentum? And in what scenarios does low vol work, or when does value work? Is there any merit in combination of value plus momentum or low vol plus momentum? How is multi-factor better? So these questions I'll answer again in separate videos one by one, because in one video it will become too much of a cognitive load to consume. So I felt it is better to do it in separate videos. Okay, that's all. Thank you guys. Have a nice day. Bye.